You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast. It is Tuesday, January 27th, 2026. And if you've been watching the headlines this morning, you might be feeling a bit of vertigo.
Just a bit.
The geopolitical map is lighting up from Washington to Kyiv, and it's causing some very strange, somewhat contradictory ripples in the financial plumbing.
Mm-hmm. From a mysterious jolt in the Japanese yen to gold just smashing through these historic psychological barriers.
Exactly. And with the Federal Reserve meeting looming, the stakes for interpreting these signals correctly they've rarely been higher.
Yeah.
We're going to unpack the new tariffs hitting South Korea, the ghost move in the currency markets, and why energy traders seem to be ignoring war rumors to focus on the weather. Let's unpack it.
It really is one of those mornings where the why matters so much more than the what. We have trade policy acting as a weapon, currency markets jumping at shadows, and commodities telling two completely different stories about risk.
And usually we can isolate these things. We can say, okay, today is a trade day or today is a central bank day, but today everything is just colliding at once. I want to start with the pin on the map that I think surprised the most people this morning. We're seeing a trade war redux, but the target isn't Beijing or Brussels, it's Seoul.
Aggressive is the right word. This isn't a subtle nudge or, a warning shot. The headline numbers had jumped from 15% to 25% tariffs on South Korean goods.
A 10% jump.
And the scope is what's truly catching the market off guard. We aren't just talking about a specific model of car or a niche electronic component.
Right.
This covers autos, lumber, pharmaceuticals, and this massive catch-all bucket labeled all other reciprocal goods.
That reciprocal goods category is always the scary one for importers because it's so broad. It basically gives the administration carte blanche to apply pressure wherever they see fit. But help me understand the trigger here. Usually when we see a tariff hike of this magnitude, it's retaliatory or, tied to a specific dumping allegation. What's the administration's justification for hitting a key ally like this?
The official line is non-compliance. The administration claims Seoul failed to enact a previously agreed-upon trade deal. So the message being sent here is stark. We had a contract, you missed the deliverables, so now we are pulling the leverage lever.
So it's effectively treating international trade policy like a penalty clause in a business contract?
Exactly. It feels less like economic policy designed to protect domestic industry and more like a negotiation tactic for enforcement.
That is the key insight.
This is the weaponization of trade policy for enforcement. It's a negotiation tactic, sure, but one with immediate hard costs. You could see the panic it caused in the currency markets instantly. The South Korean one took a nosedive right after the announcement. It was trading heavily as the liquidity dried up, and everyone tried to reprice Korean exports in real time.
I saw that on the charts. It has clawed back a little bit since then, right? It didn't stay at the lows.
A little, yeah. Mostly because the market is betting on a resolution. You have South Korea's industry minister scrambling to book a flight to Washington.
Of course.
And the ruling party in Seoul is trying to rush a special act through their legislature by the end of February. They are moving at light speed to plug this hole because they know their economy just cannot sustain a 25% levy on its biggest exports for long.
Which tells you everything you need to know about the leverage the United States holds here. But looking at this from a macro perspective, if I'm a trader sitting in Tokyo or Berlin, not just Seoul, what's the takeaway? Because this isn't just about Korea, is it?
No, it's about the rules of the game. The takeaway is constructive caution. This sets a precedent. It signals that the administration is willing to disrupt supply chains overnight to enforce compliance, even with friendly nations. It adds a risk premium to every international deal right now.
So if you're trading global equities, you have to price in the fact that a tweet or a press release can suddenly alter your cost basis by 10% overnight.
Exactly. It removes the assumption of stability. You can't assume that just because you're an ally, you're safe from the tariff stick.
Speaking of things altering suddenly, let's talk about the yen. Because while the one moved on specific news, the yen seemed to move on. nothing.
It really did look like a ghost move. This was the most fascinating technical event of the session. We saw the dollar-yen pair just crash below the 154 handle.
And for those who don't watch the ticks every second, that is a significant strengthening of the yen against the dollar.
A very sharp move.
And usually when a major currency pair moves that much, and we were talking about a sharp drop, I'm looking for a speech from the Bank of Japan, a consumer price index print, something. But the wires were quiet.
Completely silent. No intervention from the Bank of Japan. No data dump from the United States. This is what we call a catalyst light move, similar to what we saw last week with that post-2 price action.
Right.
But technically, this was critical because it sliced right through the 100-day moving average.
Okay, let's pause there for a second. For the listener who isn't a technical analyst who doesn't spend their day drawing lines on charts, why does breaking that 100-day average matter so much in a vacuum of news?
Because in the absence of news, the algorithms take the wheel. The 100-day moving average is a line in the sand for automated trading systems.
I see.
When the price breaks that level, the bots sell, which drives the price lower, which triggers more bots. It becomes a self-fulfilling prophecy. But the reason they're so skittish, the reason the market is so primed to sell, comes down to human psychology.
The fear of intervention.
Exactly. The market is suffering from what you might call intervention PTSD. Traders are terrified that the Japanese Ministry of Finance, or the Federal Reserve, is about to step into check rates. So you have this constant flinching. Every time the price dips, everyone rushes for the exit because they think, is this it? Is this the big intervention we've been waiting for?
It's like a crowded room where someone drops a glass and everyone ducks because they think it's a gunshot.
That is the perfect analogy. And this flinch was strong enough that it actually dragged the broader dollar index down toward the 96.90 area.
Wow.
The yen is so heavy in that basket that its phantom pain actually bruised the dollar globally.
Now, just to play devil's advocate, there was a headline about explosions in Iran right around the same time. Could that have been a flight to safety? The yen is a classic safe haven, after all.
It's a fair question, and initially, the algorithms probably did react to the word explosion. We had reports of blasts near Iran's Parchin site. But here's why I don't think that was the main driver. Look at the other asset classes.
Okay.
If the market genuinely believed a war was starting in the last 4 hours, oil would have skyrocketed.
Yeah.
It didn't.
So the currency market panicked, but the commodity market shrugged.
Essentially. The lack of follow-through in oil tells us the yen move was technical and psychological, rooted in currency dynamics, not a reaction to imminent war.
Well, speaking of commodities reacting to fear, or in this case, history, we have to talk about gold. I feel like we've been watching this number approach for years, and now we are finally here.
We are. Gold has officially established a foothold above $5,000 an ounce.
$5,000. It wasn't that long ago that 2,000 felt like a ceiling. 5,000 feels like a different era.
It's a staggering repricing of fiat currency, really. We're trading near $5,100 now. This isn't just a spike, it looks like a floor is being built.
Then why now?
Well, investors are looking at the trade wars we just discussed, the weaponization of tariffs, the chaos in Eastern Europe, and they're saying, I simply cannot hold 100% of my assets in paper.
It is the ultimate vote of no confidence in the geopolitical status quo. When you see gold at 5,000, it tells you that big money is worried about the systemic risk in the traditional financial system.
Precisely. It's a hedge against policy error. And, interestingly, while gold is the steady climb, silver has been the roller coaster. It saw a massive sell-off recently, mostly traders taking profits after record highs, but it has already stabilized back above $112. The complex is volatile, but the direction is clearly up.
Let's circle back to what you mentioned about oil shrugging off the Iran news. Where is crude actually trading? Because if gold is at 5,000, I would expect oil to be at 100.
And it's not. West Texas Intermediate is hovering just below $61 a barrel, which, given the headlines, is incredibly calm.
Almost suspiciously calm.
It is.
$61 feels disconnected from reality when you read the geopolitical section of the newspaper. Why aren't we seeing a risk premium built in?
It comes down to verification. The explosions near Parchin turned out to be routine missile tests, according to Iranian state media. The market has become very cynical.
So it's a show me, don't tell me market.
It needs to see actual supply disruption, tankers blocked, pipelines burning, before it prices in a war premium. Headlines alone don't do it anymore. Traders have been burned too many times reacting to rumors that turned out to be nothing.
However, there is one energy market that is panicking, but not about missiles. Natural gas.
Yes, and this is the irony of the energy transition. We're all focused on the Middle East, but the price of natural gas is being dictated by an Arctic storm. Prices are elevated in both the United States and Europe purely because it's freezing cold.
So oil ignores potential war, but gas spikes because everyone cranked up the thermostat.
It's a reminder that physical realities, weather, logistics still trump rumors. The supply chain for gas is being strained by demand right now, not by geopolitics.
Right.
If it gets cold enough, price matters more than politics.
That's a good segue, though, because while the energy market might be ignoring the war rumors, the reality on the ground in Ukraine is shifting fast. And this ties back to that constructive caution you mentioned earlier. We have reports of physical strikes, but the diplomatic rumor mill is spinning even faster.
The situation in Ukraine is effectively moving on two parallel tracks that are about to collide.
Okay.
On the physical track, Russia is hammering energy infrastructure in Odessa and Lviv. The war of attrition is very much alive, and the damage to the grid is real. But on the diplomatic track, we have a report regarding the Trump administration's stance that is potentially historic.
This is the conditional security report.
Yes. The report suggests Washington is indicating that future United States security guarantees for Kyiv might be conditional on Ukraine agreeing to a peace deal. And the kicker is that this deal likely involves ceding the Donbas region.
That changes the entire calculus. For years, the Western stance was nothing about Ukraine without Ukraine, and territorial integrity was non-negotiable. If that conditionality is real, it forces Kyiv into a corner.
It forces a decision. And for the markets, specifically European assets, this is a double-edged sword. On one hand, a peace deal stops the shooting, which markets generally like because it reduces immediate volatility.
Sure.
On the other hand, if you redraw the map of Europe by force and validate it with a treaty, what does that do to the long-term security risk premium for Poland, for the Baltics?
It redefines the security architecture of NATO, essentially. If borders can be moved, then investment in Eastern Europe becomes a much riskier proposition over a 10-year horizon.
It does. And that uncertainty is weighing heavily on European risk sentiment. You can't just price in peace. You have to price in the stability of that peace. Is it a pause or is it a resolution? The market doesn't know yet.
Meanwhile, the Middle East doesn't seem to be anywhere near a deal, forced or otherwise. You mentioned the Iran explosions were tests, but what is the actual diplomatic status there?
It's a split-screen reality. We have reports that diplomats from the United States and Iran are intensifying efforts, using back channels to try and lower the temperature.
Yeah.
It's the hope trade. But look at the ground. Israeli artillery is active in southern Gaza. The Rafah crossing is a mess of uncertainty, and there's zero breakthrough on a ceasefire.
So diplomats are whispering in hotels while the artillery is still firing.
And the market is trying to figure out which signal is the leading indicator. Usually the artillery leads. Until the guns stop, the diplomatic talk is just noise to an oil trader.
And just to complete our tour of global anxiety, Asia isn't staying quiet either. We have the tariffs in Seoul, but we also have missiles flying out of Pyongyang.
Overnight, North Korea fired multiple ballistic missiles. It triggered shelter alerts in Japan. It's the classic Pyongyang playbook. When the world is looking elsewhere, fire a missile to remind everyone you're still dangerous and relevant.
And further south, China is making waves again.
In the South China Sea, Beijing issued a stiff warning about joint patrols between the United States and the Philippines, calling them a threat to stability. They reiterated their commitment to defend sovereignty. It's the usual rhetoric.
But in this environment,
with tariffs flying and wars hot, even standard rhetoric feels more dangerous.
it feels like the margin for error is gone. In a calm world, a warning is just a warning. In this world, a warning could be a precursor to a blockade.
Exactly. The geopolitical friction is so high that any spark looks like a fire.
Okay, so let me try to sum up this picture so far. We have a trade war escalating with an ally in Korea. We have the yen moving on ghosts and intervention fears. Gold is at $5,000 because nobody trusts fiat currency. We have a potential forced peace in Europe, a grind in the Middle East, and missiles in Asia.
That's a fair if somewhat depressing, summary.
And yet, I'm looking at the futures market for United States and European equities, and they are green.
It is the paradox of our time.
How? Is the market just in denial? Is this irrational exuberance, or are we missing something? How can the S&P 500 look at a world on fire and say, buy?
I don't think it's denial. I think it's a very specific kind of compartmentalization. The market is distinguishing between macro risks and micro realities.
Meaning the companies themselves are doing okay.
Exactly. The earnings backdrop is actually quite constructive. Corporate America is generating cash. Sentiment following the recent Wall Street rebound is positive. Investors are looking at the profit and loss statements and saying the business is good.
They're betting that the geopolitical noise won't actually stop the consumer from spending.
Or the companies from earning. So for now, micro is beating macro.
For now.
But notice the texture of the rally. It's tentative. We aren't seeing a massive risk-on explosion where everyone buys everything. We're seeing a climb-the-wall of worry grind. There's a ceiling on these gains because nobody wants to be all in right before the Federal Reserve meeting.
That's the event horizon everyone is waiting for.
It is. We have United States consumer confidence data coming up, which will tell us if regular people are as worried as the headline writers. We have ADP employment numbers. But ultimately, everyone is waiting to see how the Federal Reserve navigates this minefield.
And it is a minefield.
With tariffs rising, which is inflationary, and growth threatened by war, which is deflationary, the central bank's job has never been harder.
They're caught between a rock and a hard place. If they cut rates to help growth, they risk feeding the inflation from tariffs. If they hike rates to fight inflation, they crush an economy already nervous about war.
Exactly. And that is why the yen is so nervous. That is why gold is so high. The market knows the Fed is walking a tightrope.
So if I'm listening to this and trying to position myself, what's the synthesis? Because it feels like the signals are pointing in opposite directions.
The synthesis is that diversification isn't just a buzzword right now. It is a survival strategy. You have equities holding up on earnings, so you stay invested because you don't want to miss the upside if the world doesn't end. But you have gold screaming at $5,100 that the system is fracturing, so you hold hard assets. And you have the yen signaling that liquidity can disappear in a heartbeat.
You have to play both sides of the coin. You can't be a pure bull or a pure bear.
You do. You can't bet on just growth or just disaster. You have to be positioned for a world where both are happening simultaneously. A world where tech stocks rally on AI earnings while supply chains fracture in Asia.
A world where the stock market hits a record high on the same day a peace treaty redraws the map of Europe.
That is a very real possibility in 2026. And frankly, it's the scenario that professional investors are trying to navigate right now. They aren't selling out, they're hedging.
Well, that is a heavy thought to leave us with, but a necessary one. It's not about panic, it's about preparation. We'll be watching those consumer confidence numbers closely to see if the average person is feeling that same split-screen reality.
It's going to be a pivotal week.
Thanks for listening to the Financial Source Podcast. See you next time.
Appreciate tuning in. Join us again on the Financial Source Podcast.